Hey, welcome back. Thank you so much for joining me. This is Mr. Market. We're now to episode 28. So I'm going to try a couple new things with this episode, specifically with regard to the formatting. I am going to try to set up some chapter sections. So when you go into the description for the video, you'll be able to see the sections that you want to go to, and you can skip all the other parts that you're not interested in. But I'm going to try to break it down into 4 sections. The first section is the recap for our performance. The second will be the economic data and charts that I'm looking at that helps me navigate the market. The third will be the trades and the current positions that I've got. And the fourth is where we wrap it up. Okay, so with that said, let's get started. For the past week, we had a pretty good week. We were up $2,329 or up 1.1%, while the market fell 0.26%. So for the past few weeks, the market has actually been down. It's been down about 2.47%, while we were up 0.79%. And, this market has had a pretty strong run until August, and this pullback has actually allowed us to get a little bit closer to the market's performance. Year to date, we are up 16.21%, while the S&P 500 is up 17.41%. And so, as you can see, we're underperforming the market. But by design, our strategy is meant to earn about 20% per year. So if the market is on pace to go above that, we're going to fall behind. But whether the market rises or falls, our approach is expected to earn at least about 20% a year. At least that's my goal. So since we started this thing back in July of 2022, we're up 34.87%, while the market is up 20.08%. And we've done it with far less risk. Our maximum drawdown was 76% less than the market, with the market having a maximum drawdown of 16.68%, while our largest drawdown was only 3.87%. Okay, for the second part of the episode, we are going to dive into the economic data and charts that I look at every single day to help me navigate the market's ups and downs. So let's get to it. The biggest story for the past year has been inflation, and as you can see, it's been falling pretty nicely. But the stickiest part of inflation has been housing, but as you can see here, it looks like it is ready to fall. Interestingly, if you take out the housing part of CPI, inflation looks to be right where the Federal Reserve wants it to be. So overall, we're getting some pretty good inflation data, and combined with pretty strong jobs numbers still, the overall economic picture has been improving. Which is also why you're hearing the phrase soft landing, which economists use to describe an economy that is slowing down, but not to the point of recession, but also being able to keep inflation down. So all this talk of recession has been fading away, which is what's been helping the market run up so much this year. And in terms of the earnings recession, this is the last quarter where earnings are expected to dip, and we're expected to see a recovery in the fourth quarter. So that's the bullish case for the market. Now, how about the bearish case? For starters, we still can't ignore this yield curve inversion, which has a perfect track record going back 50 years in predicting recessions. So as long as this yield curve is still pretty inverted, we still need to be a little bit cautious. One of the earlier indicators of a potential recession is the increase in jobless claims. This shows the jobless claims figures now rising above previous year's trend levels. And one indicator I like to look at is the volatility index. If you take a look at the seasonality for how this behaves, something wicked this way comes. Typically, when volatility rises, that's usually when the market starts to fall or enter into a choppy trading period. And so far, we have been falling right into that seasonal pattern beginning in August. This tends to go all the way up until October. Also, debt-to-income ratio levels are now higher than they were during the housing bubble, and at some point you think that the economy would start to feel this effect. This next one is a little bit more troubling since, as we know, the top 10 U.S. stocks make up a significantly large percentage of the overall stock market. But if you take a look at the earnings contribution from these top 10 stocks, it really hasn't moved up in sync. So there's a little bit of a disconnect here that can cause some problems down the road for the market. And if you compare the 10-year bond yield to the S&P 500, it has historically suggested a lower valuation for the market. So this is another thing to watch out for. And finally, when you look at the trends in the market, we're starting to see a little bit of a crack. The upward trend that started in May has now broken to the downside, but the one in March and in October is still intact. So this really bears watching. Okay, for this last part, I'm going to be talking about some of my trades over the current earnings season and my current positions that I've got for the week ahead. For earnings season, my rule is to sell options in accordance with the pre-existing trend. So if something is bullish, I'll sell puts. If something is bearish, I'll sell calls. And if something looks like it's in a sideways trading pattern, I'll sell strangles, which means I will sell both puts and calls. So for Apple, the trend was bullish heading into earnings. And even though the earnings were disappointing, that upward bullish momentum gave it enough force to allow dip buyers to come in and stay above my $170 strike price. AMD is a similar story, so I sold puts at $105 and $100, and that also worked out. Disney's a little bit different since I sold a put and a call, even though the chart was a little bit bearish on the weeklies and dailies. But since it had been close to the pandemic lows, I was willing to bet that buyers would come in at that level to support it. And so the strike prices at $100 and $80 worked out great, and both expired worthless. This one's a little bit different. This is KBE, the large bank ETF. Now, this one started to go break out of its relative downtrend to the S&P 500. And also, if there is going to be an economic recovery and we're going to avoid a recession, this is probably going to be a pretty good beneficiary. So I sold some longer dated puts over expiring in December at the $33 and $32 strike price, and I plan to hold this as long as this trend remains positive. Also, there tends to be a pretty good correlation between the bank stock price and the earnings, and as you can see here, the price has diverged significantly from its forward earnings. So if there's going to be a recovery, this gap is going to provide a little bit of an upward boost for the bank stocks. Last week, the bulk of my gains came from selling a strangle on S&P 500 ETF, symbol SPY, SPY. The pendulum algo had become pretty negative, and so I started to go sell some calls at the $460 strike price, but it looked like there was some support near the 440s level, so I sold some puts at 443, 441, and 440, and that worked out very well. Now for this coming week, the algo is still negative, so I sold some strikes over at 435 and $430. It is a little bit of a concern for how the market is starting to break down, so I'm playing it more cautiously this week. Two factors that are making me more cautious about the market. Number one, the momentum has started to turn negative on a daily basis, and this tends to have a little bit of a longer term effect. And the second, one of my indicators that I like to use shows the buying and selling pressure of the intraday charts. And when it turns negative, that means rallies get sold and they tend to fail. And so it's now below the zero line, and it has corresponded pretty closely to the market's failure to rally over the past few weeks. So as long as it stays negative, I need to be cautious as well. So that's all I've got for this week. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. And also you can find me on the web at mistermarket.us or mistermarket.us. So thanks again for joining me. I hope you have a good week trading, and I will see you next time.